This one chapter in trade life cycle, investment finance, always scares everybody. Not because it's really that fearful, it's not something that's to be scared about because it's not like this gorilla topic, but just there's so limited information about it. Hello, everybody, and welcome to this lesson on understanding fixed income securities. I know many of us are very familiar with equities, and I can see with the number of subscribers who've been added in since the last video. Thank you so much, everybody, for joining into this video because your subscriptions really matter to me. That's my only motivation, okay? The more you share the videos, the more you like the videos, the more comments you pass, the more you criticize me. I know you're listening in, you're liking in, you're learning in, and you're getting that dream job in an investment bank or a hedge fund, wherever in the world that you can be seated out. Let's take a look at understanding fixed income securities. We've already covered two lessons. The second lesson was on understanding equities, where we spoke about the different type of equity instruments, including different types of preference shares as well as differential voting rights, American depository receipts, etc. We now talk about the third lesson, takes a look at fixed income securities, and the next lesson is going to take a look at the different market participants so that we understand the market ecosystem before we understand the trade life cycle. Fixed income securities are associated with many terms. If you've heard of coupon, bond currency, repayment schedule, all these are terms associated with fixed income securities. To give you a little background about what are fixed income securities, they basically are debt obligations that can have coupons, not have coupons, that have to be repaid on maturity, that cannot be repaid on maturity. There's so many flavors. It's like entering an ice cream shop and staring at over 108 flavors of ice cream and not knowing which one you want to buy. So before we delve into each of those aspects of fixed income securities, let's take a look at what is a fixed income security and what do we mean by that. Fixed income securities are also called as tradable debt. Mark the words tradable debt. Tradable means it can be sold. Okay? So they are negotiable instruments. And after they are sold, the ownership is transferred to the new buyer. Okay, so you have a lot of debt, especially in countries like India, which are not tradable at all. They're non-tradable debt. These kind of debt, like mortgages, like investments in long-term provident funds, etc., cannot be traded in the markets, right? They're locked in for 15 years, 20 years, and even longer in some other countries. That's not debt. That's not under the consideration of fixed income securities. What is under consideration of fixed income securities is tradable debt. That means there exists a market for that debt to be traded on, and that's a very important term for us to know. The second aspect is it could be called as bonds or debentures in different markets. Now, in most markets of the world, it's called as bonds. In some markets, especially those that were ruled by the United Kingdom through the 19th century and 20th centuries, use the word debentures. So typically, if you're studying an accounting system that follows the British accounting system, then you would say that bonds are secured, debentures are not secured. But if you look at the globalization of the markets and the fixed income securities market as a whole, then the terms are used interchangeably with most global markets, the United States markets, the European Union markets, the Japanese markets, all using the terms bonds. Whereas the ex-colonial markets like India, like Australia, we kind of tend to use the term debentures. For all practical purposes, the description of that security will be mentioned in the document itself. What is the document? The document is called as the indenture. So now let's try and understand what are the different types of bonds on the basis of collateral. If you have to categorize the bonds on the basis of collateral, you have two types of bonds, unsecured bonds and secured bonds. For purposes of this video, I'm going to be using the term only bonds because that's what the global markets use. It's very difficult to find markets that use the term debenture, so let's go ahead and use only the term bonds. Unsecured bonds, or let's take a look at what are secured bonds first. Secured bonds are those bonds that are also called as senior bonds. These bonds have a priority in the claim stack. Okay? Now let's understand this particular slide very well. A bond that is backed by collateral is called as a secured bond. A secured bond holder has a priority in claims with respect to asset sales when there's a bankruptcy. Therefore, senior bonds are bonds that are very high in demand, especially if the borrower doesn't have that greater credit rating. These secured bonds provide a comfort by way of collateral to the bondholder that in case a company becomes bankrupt and files for liquidation, then the company will sell its assets and pay out the secured bondholders first. Unsecured bonds are subordinated debt. Subordinated debt are those that do not have any collateral. Yeah? Therefore, their priority in claims comes much later. Let's say a company becomes bankrupt and they file for liquidation and they have both secured debt as well as unsecured debt in their balance sheet. And the company is not able to pay interest on both these loans and therefore it's become bankrupt. And the company files for liquidation and the assets are sold. Then the secured bondholders are paid first. And after they are paid, the unsecured bondholders are paid later. That's what is the meaning of priority in claim stack. So the basis of collateral, we have secured bonds versus unsecured bonds. On the basis of whether the bond is giving you a coupon or not, we have coupon kind of bonds. The first type is zero coupon bonds versus coupon paying bonds. Let's take a look at what are zero coupon bonds. Zero coupon bonds, acronymed as ZCB, are issued at a discount to the par value. Par value means the value at which the bond is nominally priced at by the issuer. Hence, in some markets it's called as par value, in some markets it's called as face value, in other markets it's called as nominal value. It all means the same thing. So if the bond is issued at a discount to the par value and there is no coupon payment in between the issue date and the maturity date, the bond is redeemed at par value. Such a bond is called as a zero coupon bond. Is this making sense? Okay, so a coupon bond, as the name suggests, has zero coupon because it's paying nothing in between the issuance date and the redemption date. So it's issued at a discount of the par value. There are no coupon payments to be made and it's redeemed at par value. Example of a ZCB, okay, this is just a fictitious example. There's absolutely nothing truthful about it except that it is perhaps one of the examples that I could dwell out from my own brain. KH Inc. has issued bonds at $97.5. The bonds mature after 5 years at a price of $100. This means the bond is issued at $97.5. The par value is $100. The redemption price is $100. The maturity is 5 years. The bond is not paying any coupon from the issuance date to the redemption date. That means this is a zero coupon bond. All right. A coupon bearing bond, on the other hand, could be a bond that pays coupon at predetermined intervals. Therefore, is issued at par value. The frequency of payment of coupon is predetermined and it is redeemed at par value. So the cash flows that are accruing to the investor are the coupon payments and the redemption price. So remember this, par value is the same as face value or nominal value. Coupon is also called as interest in some markets in the world. Before the bond investor buys the bond, they will know what are the frequency of coupon payments, whether it's monthly payment, quarterly payment, semi-annual payment, annual payment, etc. And they will know the maturity at which the bond is going to be redeemed. So coupon bearing bonds therefore give coupon payments to the investor. So to sum up, on the basis of coupon payments, we have zero coupon bonds versus coupon bonds. On the first factor, they're issued at a discount to the par value. In the case of coupon bonds, they are issued at par value. The zero coupon bonds are redeemed at par value. The coupon bonds are also redeemed at par value. Okay, so there's no difference in between the maturity amounts that ZCBs or coupon bonds actually pay out to the investor on maturity. And finally, no coupon payments to be made by the ZCB issuer during the issuance date to maturity date. So as long as the bond is outstanding, there is no coupon payments to be made by the issuer to the investor. But in the coupon bonds, they pay coupon at regular intervals of either quarterly payments, semi-annual payments, annual payments, whatever are the terms and conditions mentioned in the indenture. Moving on to the third premise. What is the bond's currency? Currency means, is it a dollar bond? Is it a euro bond? What do we mean by that? On the basis of currency, we have domestic bonds versus foreign currency bonds. Let's take a look at what do we mean by domestic bonds. In a domestic bond, issued in the home currency, traded in the home country, typically a US dollar bond issued by American corporations traded in the US markets is a domestic bond. This is fairly simple to understand because there's no foreign exchange risk with respect to conversion of the bond cash flows, either the coupon cash flows or the maturity proceeds from one currency to another. On the other hand, you have foreign currency bonds, which are issued in currencies other than the home currency. It's called as a foreign currency bond. For example, a US dollar denominated bond issued by a Swedish corporation. Now, why will a company which is headquartered in Sweden issue bonds denominated in dollars? Okay, this happens very often prior to the COVID days because USD interest rates were very low. Even during the COVID season of 2020 and 2021, because the markets were looking so depressed, the Federal Reserve kept decreasing and reducing the interest rates. The Fed rate completely crashed, during the COVID era. And therefore, there was an era of extreme low interest rates. And companies across the world, which operated in countries with high interest rates, thought it would be a great idea to borrow money in currencies which had lower interest rate. So, foreign currency bonds are those bonds that are issued by by companies in a currency other than the home currency. In the US, these bonds are called as Yankee bonds. Yankee bonds are bonds issued by foreign corporates in USD. Okay, like the example that I just gave you of the Swedish company issuing bonds in dollars traded in the USD markets, it is indeed a Yankee bond. On the other hand, you have domestic bonds, bonds that are issued by US companies in USD. So there's no foreign exchange risk over here. The fourth categorization of bonds would be whether there is early redemption or not. On the basis of that, we have callable bonds and puttable bonds. Okay, so can a bond be redeemed before maturity? That has to be known to the investor before the bond is maturing, before the bond has been invested into. Obviously, you're an investor into fixed income security. You want to know whether the bond can be redeemed before the maturity date or not. Let's take a look at that. A callable bond is a bond which can be redeemed before maturity. So is a puttable bond. But a callable bond is redeemed before maturity by the issuer. Okay? The issuer, that means the company that has borrowed the money and issued bonds against that borrowing, can call the bonds back before maturity. Whereas puttable bonds are those that can be redeemed before maturity by the investor. So the investor exercises the put option and then decides to ask for early redemption of the bonds. A callable bond, therefore, is one that generally sees a heightened activity by the issuers when interest rates are increasing. Interest rates are decreasing, and puttable bonds are those which see a lot of action when interest rates are increasing. Okay, so callable bonds and puttable bonds are those bonds that can be redeemed before maturity. Coupon payments are paid at regular intervals. On the other hand, we have bullet repayment where there is no coupon payment made at all during the entire life of the bond. And the coupon payments, along with the principal, are made at one shot on maturity. This is where your factoring comes in. That's your discounted cash flows, finding out the future value of the cash flows, etc. Makes tremendous interest. So the coupon is paid at regular intervals. It's a simple interest calculation. If it's a bullet repayment where the interest is compounded and the interest payment is not made by the bondholder during the time from issuance date to the maturity date, then the bullet repayment will take into consideration the fact that the maturity value plus the coupon payments have to be made. A clean price in the markets of traded bonds. We come across this term very often. What is the clean price? The clean price is the price of the bond that is traded on the OTC markets. This is also called as the market price of the bond. On the clean price accrues interest. The accrued interest is the broken period interest. So there is a period during which the coupon is paid to the buyer of the bond, and the bond buyer is not entitled to that coupon payment in its entirety. So the bond buyer must give back the seller the interest for which he was holding the bond duration. That is called as accrued interest. This is used for settling a bond sale. So if you're in corporate actions, whether you're working in Goldman Sachs, Morgan Stanley, JP Morgan, whatever, you will obviously have to do settlements of fixed income securities. You have a clean price, that's a traded price. You will calculate the accrued interest. The clean price plus the accrued interest gives us what is called as the dirty price, or the price of settlement. So clean price is the market price, dirty price is the settlement price. I've already uploaded a few videos on calculation of accrued interest, clean price and dirty price in my YouTube channel much before this video, but I just wanted us to know the terms because we are now doing trade life cycle processing. The next video is going to be on understanding the different market participants like custodians, depositories, transfer agents, and their like. Thank you so much for listening into this video.